Hi everyone, welcome to ACCA Performance Management and Management Accounting Revision. We want to do a revision on standard costing. So this is the question that I want us to look at. This is the question that I want us to look at. This is the question. Right, so I'm pretty sure that everyone has the question. Now I want us to hammer this question enough and earn some good marks, right? So we want us to calculate the materials variances first. So they want us to prepare to calculate the material usage and the material price variance. So I want us to kill two birds with one stone. This is what I want you to do. So in the exam, I want you to apply SAR and then SAR. So that's your formula. You apply SAR, then SAR. So when you are doing the material variances, on your left side, this is the quantities. On your right side, these are your prices, right? Then we are also going to do the labor variance, right? Direct labor variances. We need the for labor, we do have the efficiency and the rate variance. So on the efficiency, we want to measure the efficiency of the employees. So there will be the expected versus the actual. Then same thing on the rate, expected versus actual, the amount that is ready to pay versus the amount that we actually paid to the employees. So again, you apply SAR. This is your SAR. Multiply by, then you just say SAR. Your SAR, then your SAR. Yes, let this be your national anthem. Right, so on your left side now, this is now labor. So we are now looking at the hours versus the rate. Hours versus the rate. So this is the formula. You have to master this formula. SAR, then versus SAR. So let's start with the material. I'm only doing the direct material A. If I do A, that means that's enough. Even B is the same thing, right? So the first thing, okay, you can even just write what was given, or you can start by solving on your left side, then you conclude with, then this will be your final. So let's start with the left hand side. We do have the quantities, but this is the standard quantity, meaning the quantity that you expected. And here for A, what do we have? For A, we do have the kgs. For A is kgs, right? So kgs here. But for product, for B, that we do have the liters. So what is the actual? Firstly, we are given what was expected. Then the information that is at the bottom, this is the actual results, right? So about A, I need information about material A. Direct material A, there is 10 kg that was expected at a price of $20 per kg. Then on the actual side, they are telling us during April, the actual results were as follows. Production, there is 800 units. Then material A, 7,800 kgs were used, costing 159,900. So we actually used 7,800 kgs. So this is the actual kgs. 7.8. What about the standard quantity? You flex the budget. The budget, this is what you are expecting. So how do I get the standard quantity? Standard quantity, we say the standard kgs per unit multiplied by the actual production units. So what was the standard kgs per unit? The standard kgs per unit, the number of kgs that we expected now per unit. So according to the question, we have 10 kgs per unit. So we were expecting to use 10 kgs per unit. And how many units do we want to produce? the actual units. So we are expecting that to use 10 kg for every unit. This is what we are expecting, and we have discovered that actually we produced 800 units. So according to the budget, we are expecting that 800 units needs how many kgs? 800 units needs 8,000 kgs. This is what we are expecting in total. It should be based on the actual results. So that's how you flex the budget. So standard kgs per unit by actual production units. Then you get 8,000 kgs. So this is what you do. You flex the budget. The same as when you do the labor, again, you flex your standard hours. Easy. Right. Then on my right side, I now need to multiply with the prices. But the amount that you take, make sure it has to be per kg. Because on my left side I do have kgs. So I need the price per kg. Price per kg, the standard. What am I given? This is $20 per kg. $20 per kg. But I don't have the actual price per, this is AP, the actual price per kg. So most of the questions, you won't be given the actual price per kg, but you'll be given the actual cost for the materials. So according to this question on material A, they say that 7,800 were used, costing 159,900. So I'm given the actual cost in total. So this is A, this is A, this is actual. So I'm given the total actual. So there's no need to calculate the actual price, because our aim is to get these totals right. So then I'll multiply, then when we do the number crunching, this should be 160,000 using exhibitors, straightforward, right? Then if you do the number crunching here, you get 156,000. Then there is a difference of 4,000. There is a difference of 3.9. Right. So we are when you apply SAR, just know that we are moving from top to bottom. Right. From standard to actual. SAR. Standard to actual. So the expected cost is 160. Then the actual cost, there is a decrease in cost. So therefore, the cost decreased, meaning this is what? This is favorable variance. Then here the cost increased, meaning this is adverse variance. The cost increased from 156 to 159. There is an increase, meaning the cost increased, hence it's an adverse variance. Right. Which is our usage variance, which is our price variance. Let's analyze. There is a variance of 4,000 here. So these two costs are different. What has caused these amounts to be different? Is it the standard price or is the quantities? It's not the prices that have caused the difference. Therefore, it can be price variance, but it is the quantities that have caused the variance. Therefore, it is the usage variance. Easy. This is my usage. This is the usage variance. Common sense, you're expecting to use 8,000, then actually you used 7.8. You used 7.8, you didn't waste the resources. It's favorable variance, it's usage variance. Easy. Right. So that's it. What has caused these two to be different? Of course, it's not the quantities, but it is the price. Therefore, it's price variance. It's price variance. Then if the question says give us the total variance for material A, what about the total? The total, you just sum up these two. So if you have the 4,000 favorable versus the 3.9 adverse. So favorable and adverse is not like with like. So on your calculator, 4,000, then 4,000 represents positive. Adverse represents negative. So I will then get the total of 100, which is greater, favorable. So this will be 100 favorable, the total material variance, right? So that's it. Then, to prove that I've got this right, I'll just compare I've said that the total variance is unfavorable. Can you see? Can you compare the one that is on the top versus the one that is on the bottom? This should give me this versus this. The one that is on the top versus the one on the bottom. This should give me the total variance. 160,000 less 15900. Total variance of 100. Normalizing the abnormal, right? Then that's it. Then we move on. So for material B is the same. You then what you need to do only is to adjust where we have kgs. You'll be writing the liters here. Liters here. Liters per unit. Still you use the actual production units of 800. So that's the same that we do on the material B. So then on the labor budget, now, what you want is, you apply SAR is the same. Right, on the labor budget, SAR, then your SAR, you have your hours on your left, right. What is the actual hours? Do we have the actual hours worked? You just go to the direct wages. They are saying that 4,200 hours were worked. So this is 4.2 hours, 4.2 actual hours. What about the standard hours? You have to flex. So this is the formula. How do you flex? You use standard hours per unit multiplied by the actual production units. You multiply by actual production units. So the standard hours per unit, according to the question, how many hours are we expecting? 5 hours per unit multiplied by the actual production. Don't forget your question. We used 800 last time is the actual. So 5 by 800, you then get 4,000 hours. So this is your standard 4,000 hours here. You do have 4,000 hours. You then multiply by the rate. Look at the left side. You have your hours. So that means I need the rate per hour. So that I'll be able to multiply with the number of hours. So the rate per hour, according to the question, we are expecting to pay at $6. So what about the actual rate? Actual rate, don't be worried if you are not given the actual rate. Probably you'll be given the total amount. So actual, what's the total cost they have actually paid. So on your actual, at the bottom, they told us that 4,200 hours were worked for how much? 24,150. So that's the actual 24,150. You have your actual here. Then you multiply them. You multiply. This is 25,200. If I multiply 4 by 6, this should be 24,000. Yes, 24,000. Then there's a difference. We are moving from standard to actual. When you compare your variances, there is a difference here. There is a difference here. So the difference between these two. There's a difference of 1.2. Then this side, there's a difference of 1050. Right. So if you compare from 24 to 25, we are moving from standard to actual. So actually the cost increased, meaning adverse. From 25 to 24, the cost decreased, meaning favorable, right? Then that's it. So we have the actual variance, we have the favorable variance. So we said that on labor we have efficiency in the rate. So I can compare what has caused the 1.2 variance. These two costs are different. What has caused the differences? Is it because of the rates or because of the hours? It's not because of the rates. These two costs are different, not because of the rates, but the rates are the same. But it's because of the number of hours. So it is the hours which means that we do have efficiency variance. Standard, we're expecting to take 4,000 hours, actually by the 4.2. So this is the efficiency variance. Then the last one, this is the rate variance. Then when they say give us the total variance, on your adding machine, negative represents, adverse represents negative. So negative 1.2, then you add the favorable of 1050. So if you say negative 1.2, then you add 1050, you get negative 50. So your total variance, that's negative 150, meaning it will be adverse. To prove that the total is correct, to prove that everything that I've calculated is correct, you just compare the amount that is on the top, this one, versus the one that is on the bottom, this one. You compare the differences, 24,000 versus 24,150. The difference, that's the total variance, that's 150, easy. Then the last thing now, okay, I need these hours, right, on SAR, that was 4,000, we flipped the budget and we actually got 4,000, okay, that's fine. So the last thing I want us to look at the fixed overheads. The fixed overhead variance. The fixed overhead variance. If you read the question, they've said that the fixed overhead included in the standard is based on expected monthly output of 900 units. So we are given the expected output, which is 900 units, and the actual output was 800 units. And they are telling us that the fixed production overhead is absorbed on the basis of direct labor hours. The fixed overhead is absorbed on the basis of direct labor hours, meaning that the fixed overhead costs are affected by the labor hours. So we are going to take the labor hours and we are going to use them to calculate the fixed overhead variances. Now on the fixed overhead variances, we do have the efficiency, the capacity, and the expenditure variance. Right, so I'm not going to use SAR here, but I'm going to use SABA. Right, so on my left side, allow me to apply SABA. You multiply by, we are now doing the fixed overheads, so you multiply by the OAR. Then the last one, that will be your AR. So you apply SABA, right? So on your left side, we are going to use the hours. So SH reflects the budget. So I said that the hours, the labor hours, are affecting the overhead cost. So you take the hours that we've actually calculated when we did the labor. So SH, we reflect the budget in SH, that's 4,000 hours. So 4,000 hours here. What about the actual hours? Actual hours on the labor, that's 4.2 hours. Actual here, this is actual, this is not actual. So 4.2 here. This is BH, this is the budgeted. Are we given the budgeted hours? If you are not given the budget hours, you calculate the budget hours in total. So what about the OAR? Are we given the budget cost, the fixed overhead cost? So some might say that on the fixed overhead we do have 50, but this is 50, is it per hour? Right, we need the cost per hour here. We need the cost per hour. We need the cost per hour, so that if you use the cost per hour, you'll be able to multiply by the number of hours, common sense. So allow me to calculate the OAR. So OAR, how do you get the OAR? Budgeted over budgeted, right? So the total budgeted fixed overheads divided by the total budgeted labor hours. So it's budgeted over budgeted. Am I given the budgeted cost? Am I given the budgeted fixed overhead cost? I'm not given as in total, but they've given me the fixed production overhead of 50. Because if you read the heading, they said the standard cost for 1 unit, meaning the following costs, they are per unit. So I am given the fixed cost of $50 per unit. Since it's budgeted, I have to multiply by the budgeted units, which is 900 units, right? Then the denominator, I'll then divide with the total budget labor hours. Am I given the budgeted labor hours? I'm not. I'm given 5 hours per unit. So for me to get the total, you then multiply by the 900 units. Right. So this will be what? 50 by 900. That's 45,000. Then That's 4.5. You get an OAR of $10 per hour. It's no longer called per unit because we have divided with the number of hours. So the cost divided by the hours, you get the cost per hour. So we have the OAR of 10 here. So this will be 10, 10, 10. Right. You multiply 40,000, 42,000. So I now have the budgeted hours, which is 4.5. So 4.5 here, this will be 45,000. The actual normally will be given the actual cost incurred. So the actual cost incurred here is 47,000. So we do have the variances of, we do have 2,000 here, we do have 3,000 here, we do have 2,000 here. So as you can see, we are moving from the standard to actual. So the costs the cost increased, meaning adverse. Here the cost increased, meaning adverse. From here to here, the cost increased, meaning adverse. So this shows that your total variance, adverse. This is one thing. This is all negative. So if you sum up, you get negative 7,000. So if 7,000 adverse. But sometimes they might say, okay, what about the volume variance? What about this? So whenever you compare the SH and the AH, you'll be looking at the efficiency. So SH and AH gives us the efficiency variance. Then this will be your capacity variance. Then the last one, this will be your expenditure variance. Right. So these are your variances. Sometimes they might say give us the volume variance. Efficiency and the capacity. These two will give you the volume variance. So you get the volume variance. If you add these two, negative, that's 5,000 adverse. So when you want to get the total variance, it's either, if you want to get the total variance is either you say efficiency plus capacity plus expenditure. So these two efficiency, 2,000 adverse plus 3,000 adverse plus 2,000 adverse. You then get 7,000 adverse. Or you just say the total variance is just volume plus the expenditure. It's one thing. Because your volume, that's what? Your volume is 5,000 adverse and your expenditure, that's 2,000 adverse. Then you get 7,000 adverse. So that's it. So you apply SAR, then you pass your standard costing. That's it. Thank you very much for your time. See you in the next online lecture.